Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why trade tensions between the EU and China may be escalating.
Plus, we'll discuss how the energy transition will drive a significant uptick in demand for metals.
But first, we begin with the computer technology company Oracle. This week, Oracle reported fourth quarter results that fell short of analyst expectations, but Oracle shares still hit a record high.
For more, we were joined by Anurag Rana, Bloomberg Intelligence Technology Analyst. We first asked Anurag why investors were so happy about Oracle.
I think the biggest thing in our view were the two partnerships that were announced, one with Google and one with OpenAI, from a future point of view. At the same time, we continue to see strong demand for the cloud infrastructure business, which has been kind of the story on cloud, on Oracle for the last, you could say, 18 months or so. So that remains strong. But remember, prior to going into the quarter, there is a lot of noise about software spending slowing down, but that's on the application side. That's a different kind of the business. But on the infrastructure side, where you're hosting somebody's application or a workload, that business is still doing well. So it's good for Amazon, it's good for Microsoft, and now it's actually good for Oracle also.
Anurag, can we put Oracle into our basket of AI stocks now?
Yeah, I mean, we've been talking about it for a while, that they would be most likely the fourth largest cloud infrastructure vendor down in the future, right behind Amazon, Microsoft, Google, and then it'll be Oracle. Now, remember, everybody's trying to get the workloads or trying to figure out how to put their AI experiments out in the cloud just to see what they can do with it. And they're running short of capacity. So when you look at a company like Oracle, which has deep pockets, can actually afford to spend more. They announced they're going to double their capex this year. Wow. So that's going to be somewhere around $14 billion or so for the next 12 months. I mean, they can spend the money, so people will come to them.
So let me just dumb it down for me here. So Microsoft and Google then are using Oracle stuff for their AI cloud infrastructure. So all the language model learning things that happen and all the data they're collecting for AI goes now to Oracle's hardware software?
Well, think about it, that let's assume that Oracle is an electricity provider, and if for any reason Microsoft feels short of it, they can go out and rent some from somebody else. I mean, because everybody is getting a lot of workloads or incoming inquiries to do things, but they're running short of capacity, and that's where they can go out and borrow. But when it comes to Google, what they basically are doing is they're saying we have a lot of companies, let's say banks and airlines, that house their data on Oracle's databases. They're going to take their servers and put it in Google's cloud data centers. So if anybody wants to run, you could say, an AI or an ML machine learning algorithm, they can then tap into that data that's housed into the Oracle database so that they can run those queries faster.
Alex, listen to this valuation story here. This is just another one that's very much like NVIDIA in terms of valuation. Trailing PE on their fiscal 2024, which ends May 31st, 24, stocks trading about 36 times earnings. On forward earnings, just on their May 2025, 22 times earnings. Oh. I mean, it's another one of those NVIDIA where this is a company that appears to be growing itself into the multiple. How do you think about valuation here, Anurag, for the Oracles of the world, for the NVIDIAs of the world, now that it seems that it's kind of a new paradigm here with AI?
Yeah, when you look at cloud infrastructure companies, one could argue that Oracle's slightly cheaper than all the others. But at the same time, their cloud infrastructure business is small, so small compared to the overall pie, which is not growing as much. Remember, after all said and done, for next year, Oracle may grow sales, let's say around 11-12%, somewhere in that range. So it's not anywhere close to where NVIDIA is going to grow their revenues for the next 12 months.
All right, so let's step back and look at your space in general here, Anurag. When we think about, I feel like we're learning something, or at least I am, every day about AI, the cloud, the spending associated, where the spending's coming from. So as you sit back and you were constructing a basket of AI stocks, kind of what would you throw in there, kind of in order, would you say?
Good question.
Yeah, it's a very good question. And in fact, everybody's trying to figure that out. But when you look at the AI basket, the bigger companies on the chip side are the first one. So that's NVIDIA, Dell's been a bigger, somewhat of a player over there. But when you come to the software side, the number one company from an AI exposure is Microsoft. And that's because of its partnership with OpenAI. Now, when you look at the downstream play, it is the cloud vendors. Now, they have a very small portion of their workloads coming from AI, but that's going to rise going forward. That's going to be the likes of Amazon, Google Cloud, and then Oracle Cloud. So these are the infrastructure players. Then the application companies. Now, these companies are right now experimenting with products. They don't really have a full, massive suite out there. That's the like of Salesforce or ServiceNow, companies that are experimenting with it, or will have smaller products or newer products coming in. Adobe is actually another one that actually stands out for us because they have a product that's working very well. We'll see what they do about it.
Oh, really? Because I feel like, isn't the whole thing with Adobe is that they haven't unveiled the right AI product or anything along those lines?
Well, they have one for creating images, so that's doing really well. The next one everybody's waiting for is the AI product that can create videos on the fly. Now, the big controversy on Adobe is that, why do I need to buy a software when I can create these images through, let's say, ChatGPT? But it's not just about creating images. First and foremost, when you use an Adobe product, you first of all are not worried about copyright issues. Second thing, you really use Adobe for editing and the entire workflow process, not just creating images. So creating images can be a commodity, but editing and actually giving out a big story, you still need a software for that.
Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst.
We now take a look at one of the Bloomberg Big Take stories featured this week on Bloomberg Intelligence. It focuses on the recent exit of talent at the Federal Reserve Bank of New York, and the piece is titled, Talent Exit at Williams, New York Fed Stokes Concern on Its Way.
For more, we are joined by Alex Harris, Bloomberg short-term interest rate reporter. We began by asking what exactly is going on at the New York Fed.
What's kind of happened over the last couple of years is you've seen an exodus of basically senior management. These are people who have been with the bank for decades, just deciding to exit, either that they retire or that they, find another opportunity on Wall Street, or just really. But what's ultimately driving it is the environment is just not. They have found just not conducive, either that, there's been changes in the bank under, the leadership of John Williams that they have found, doesn't necessarily work for them anymore. And as a result, they're leaving. And what people are worried about is the so-called brain drain. It leaves a vacuum of people who are experienced at fighting crises. Because remember, a lot of these people have been there. They were there for the financial crisis. They were there for the repo market blow up. They were there in 2020. Like, they have crisis fighting experience, and so you're leaving a lot of that knowledge is leaving the bank. But then also just their ability and the question of, are they ready for whatever's next? And that's what people are really concerned, is they're feeling like something's severely lacking under the leadership of John Williams.
First of all, I love that you wrote this, because Alex is usually the person that has those really nerdy repo market articles where you're like, I know this is important. I know I'm going to read it 3 times, and I'm still going to understand 20% of it, and I have to email Alex Harris. So thank you for writing an article that I understood right off the bat. What did they do about that then? I mean, is it as easy as like, hey, we're going to offer more work from home? Is it not that at all? Is it something very different?
I think it's very different. I think really what people are going to have to start looking at is taking a really serious look at the role of the New York Fed. For some people, they've said, look, Lori Logan got elevated out of the New York Fed to running the Dallas Fed, and she's taken a lot of that staff with her. She has this experience on the balance sheet. People really trust her. So now people are wondering, well, it doesn't necessarily have to be New York that carries out, the implementation of the Fed's policies when it comes to their balance sheet. Like, this could shift to Dallas. So people are starting to ask that question or pose that question. At the same time, though, people are pushing back and saying, no, this has to be in New York. We need to fix what is happening in New York. We need to retain talent in New York because the banks are here. And if something happens with the banking system, it's much easier to call everyone down to Liberty Street and say, hey, get in here, we got to figure this out, than trying to call people all the way down to Dallas and say, hey, we got to figure this out.
So historically, the New York Fed has been the branch that manages Treasury's balance sheet, correct? Buying and selling bonds?
Well, the Fed's balance sheet.
The Fed's
their
balance sheet,
holdings are Treasuries and MBS and such.
Again, they have traders there and stuff that do this. I mean, this is where it happens in New York.
Well, and you have other, like Chicago still has, market analysis people. Like, they still have all these things coming out of the other banks, but it is primarily a function of the New York Fed. They're tasked with managing their Fed's portfolio. Roberto Perli is the SOMA manager, so he manages the Fed securities portfolio. So these things, and so the New York Fed really post-financial crisis has just taken on such a larger role. They've essentially become like a giant broker dealer, just given the size and the sheer size of their balance sheet. And that's, someone like Christopher Whalen is making the argument that you don't need an academic running the New York Fed. You need someone who's comfortable with operations, with the nuts and bolts, and can kind of see it from a more markets-oriented perspective than an academic one.
So how do they pitch that? Because who's going to give up a job at Goldman that pays a nice chunk of change? Actually, I have no idea how much the New York Fed does, but I have to assume it's less. But how do they do it?
It's like I think when I last look at the annual report from 2023, I think it's like a little over $500,000 that the president of the New York Fed makes. Mm-hmm. But I mean, look, Beth Hammack, who ran the Goldman Sachs funding arm, she's elevated. She's taking the role as the Cleveland Fed president. Lori Logan could always, people are speculating that she could come back to New York and run it. These are the kinds of people I think that they envision when they're thinking about the role and who could possibly, helm the New York Fed after John Williams decides to retire or step down.
Do we have a problem with John Williams? Are people placing the blame on these departures on John Williams and his style, or?
You know what? I think it's a bit of both. I think, when we spoke to people, the message was always, he is a brilliant macroeconomist, but just ill-suited for the role. I also think culturally, the other sense I got from people is that, culturally, it's very different than the San Francisco Fed, which is what he was running for 7 years before he came and took the role in New York. It's just very different. And, sometimes culturally people don't fit, and that's okay. And so that's something to also think about. So I think it's a bit of both. I think it is somewhat of the culture and just sort of a not meshing.
Right.
They were just sort of ill-suited for each other.
Our thanks to Alex Harris, Bloomberg short-term interest rate reporter.
Coming up, we're going to break down why French President Emmanuel Macron's call for a snap legislative election may be a serious gamble.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move now to politics. French President Emmanuel Macron recently called for a snap legislative election.
That's after Marine Le Pen's far-right National Rally Party defeated Macron's Renaissance Party in European Parliament elections.
The consequences of Macron putting politics above economic stability could be profound, and it's the subject of a Bloomberg opinion piece this week titled "Macron Plays Fast and Loose with Investor Faith."
For more, guest host Jess Menton and I were joined by the story's author, Marcus Ashworth. He's a Bloomberg opinion columnist covering European markets. We first asked Marcus for his reaction to what we saw in Europe this week.
I was thinking that, this was a long time coming, but it was worse than perhaps everyone, including Macron, had expected. And therefore, it put him in a very difficult situation with, I guess, his main opposition polling more than twice, which his party got. They only got like 15% or something. So though he has another 3 years as president, if he wants to, I don't think he'll resign, but there was some question about that. He means he won't have the ability to equivalent of Congress to be able to do very much. He can still do a lot of presidential decrees, but nonetheless, it's boxed him in. And more importantly, he can't run again. By then, by 2027, his 10-year legacy would be pretty poor. So I think what he's deciding to do now is gamble on a political swing, which has gone to the right wing, that perhaps the French people, if they're challenged again, may push back against that. But the consequence of this is that the bond market in particular, and the stock market, and to some degree the economy, is going to have to take a little bit of how can we say this, a bit of a shakeup, because politically, this is a very aggressive move, and it also puts into very much sharp contrast the financial fiscal situation of France, which is rising ever inexorably higher in debt, and particularly its budget deficit. Its annual spend is much more than it takes in. It's 5.5% last year, which is pretty shocking, and not likely to drop much by next year. And I think the European Union could put it into sort of double secret probation. They call it an emergency deficit procedure. But really what it means is that in the sin bin, and that's hugely embarrassing for Macron or any government. But the point is the rating agency, the credit rating agencies, we saw S&P at the end of May knock France down to a AA minus. Fitch are already there. And Moody's came out and basically said they're one notch up at AA2, but they may be having a look at it. So it's all about a worsening credit of France, a worsening political regime, which makes the European Union very nervous. Because, we've seen with the previous situations with Greece and with Italy, they'll turn the blind eye to most things, but they want everyone to be very much pro-Euro. And Marine Le Pen's right-wing party, which is the National Rally, though they no longer argue for Frexit or France exit, they once did. And memories are pretty long in Brussels. So the last thing they want is a non-fully backing Euro-style prime minister, even under Macron as president. That'll be very unsettling for Brussels. That means it's very unsettling for credit rating agencies. Panic, panic, panic. It means that French debt is perhaps a little bit more risky, still pretty safe, but a little bit more risky than it was before the weekend.
You were talking about how France has seen a sustained deterioration in its fiscal position, particularly when you're looking at its debt load. How did France get into this position?
They spend more than they earn, or more than they tax. The reason is, Macron was elected on reforming the fiscal situation, and principally one of his key things was raising the retirement age, which he raised from sort of really 60, 62 up to about 64. He wanted to get it up to about 67, which, for instance, is where the UK is, but massive pushback. And the fact he very basically couldn't get it through unless he pushed it through by this, as I mentioned before, presidential decree, worried some of the rating agencies then. Now the fact that he has gotten really no way of getting stuff through the National Assembly, their parliament or Congress, is a really scary situation. So, that means there's even less chance of any form of fiscal improvement, of getting that budget deficit down and reducing the overall indebtedness of France. And that's a pretty difficult situation, complete gridlock, because if the National Rally were to become the party to have the prime minister and try and form some form of cohabitation, I think it's in English, is that they won't get any, they won't allow any form of spending cuts or anything to reduce the benefits that a lot of French people. 58% of the French economy is state spending. It's a very socialist driven state, and they don't like their benefits getting touched, which means nothing will happen at least 2027. No improvement on the fiscal outlook. That's very bad news for bondholders, for credit rating agencies, and indeed probably for European Union cohesion.
So I note in your column, Marcus, perhaps one of the rationales for Macron's boldness here is that it will actually force Marine Le Pen to maybe reveal what her plans for the economy are. What do we know, or what don't we know?
Well, they deliberately, a bit like the Labour Party is about to take power in the UK, they've been very, should we say, recherché in telling us what they are actually planning to do. And Marine Le Pen has basically said no to many things, but hasn't told anyone really what they're planning to do, how she would sort the pension situation out. But the one thing we know for sure, they are pretty anti-immigration, and they are pretty anti the pension changes and any other form of benefit changes. So it's going to be almost impossible for the government to stop its welfare spending bill, and that can only mean essentially this would be a deficit and debt to GDP ratio negative scenario. I would think it'd be very hard for her. But Macron's gamble is precisely as you laid out, is that if they put them in power, at least nominally, the prime minister doesn't have anything like as much control as you would think, but they have ability to try and put some things through. If they turn out to be incompetent and they turn out not to do what they said they were going to do or anything like this, it would make the presidential elections in 2027 a little bit more anti the National Rally and pro, should we say, Macron's or more centrist. The huge gambles, it could go the other way. These guys could turn out to be very good in power. In fact, the center right are already talking about maybe teaming up with the National Rally, the far right, and creating an anti-Macron coalition. That could become very popular, and we could see it would be a very stupid gamble that Macron's taken. We just don't know. The point is, if you're a bondholder, and indeed, as you've seen with the French banks like SocGen, got hit really hard. Why would you want to take the risk and perhaps go to somewhere a little bit more safe like Germany or, I don't know, somewhere else in Europe?
Our thanks to Marcus Ashworth, Bloomberg Opinion Columnist covering European markets.
Staying in Europe, this week we heard that the European Union will impose additional tariffs on electric cars shipped from China starting next month. This could take levies to as much as 48%.
It's a move that further escalates trade tensions between the EU and China, and it also adds to the cost of buying an EV.
For more, we were joined by Craig Trudell, Bloomberg Global Autos Editor.
We first asked Craig for his take on the tariff increases.
This is huge news. It was anticipated, but the particulars are something that are very fresh. So the European Union launched this investigation last year into the extent of the subsidization of electric vehicles by China, which are increasingly coming into Europe and really able to compete with local manufacturers. There's been concerns about Chinese cars being able to undercut companies like Volkswagen and Stellantis and Renault. SAIC, the maker of MG, which is a British brand that was sort of brought back from the brink by a state-owned company in China, SAIC, they are going to be subject to a 38% additional tariff. And MG's really been sort of lighting things on fire here in Europe and in the UK in terms of really being able to push a lot more volume the last couple of years. Another big manufacturer that's going to be subject to a substantial tariff will be Geely. They, of course, own Volvo and Polestar and some other big brands. BYD is another company that will be subject to 17% additional tariff. And the rest of the industry will be subject to a weighted average duty of 21%.
So talk to us about just the EV market and the China's percentage. Like, what's China's market share in Europe of EVs broadly defined? Because you can't find one here in the U.S.
Yeah, I mean, it's tricky because it, of course, depends a little bit on how you define it. And I think one of the things that's really interesting here is that it's not necessarily just Chinese companies that are doing this importing. The biggest importer, as a matter of fact, is Tesla. They have the plant in Germany where they make Model Ys, but they don't make Model 3s there. So they've been shipping an awful lot of Model 3s from their plant in Shanghai. They, interestingly, are going to try to have a lower duty rate and make the argument to the European Commission that because they've been benefiting less than other manufacturers from subsidies, that they should have a sort of commensurate duty rate. Other manufacturers are able to make that request and have what's called a individually calculated rate, but if at this juncture the only company that we know that's asked for that and may get it is Tesla.
Here's what I don't quite understand, and I know I'm kind of beating my head against a wall on this one, but if the goal is to go green, why wouldn't they want to flood the market with a ton of Chinese EV imports and get the green stuff going? And I appreciate that they want to protect their car manufacturers, but importing cheaper EVs also spurs competition. So the line to thread the needle I find to be very confusing.
It's absolutely needle threading or tightrope walking, pick your metaphor. And it is a very valid question. And depending on who you ask, they're doing absolutely the right thing here, or they're really sort of shooting themselves in the foot, folks in Brussels. The debate here is to what extent do local manufacturers need to be protected from the fact that China has jumped out to this huge lead. They're dominant in this space. They're able to, bring electric vehicles to market with much cheaper batteries that people can actually afford. And that's been, the major, sort of pain point for the industry is they have not been able to bring prices down far enough, fast enough for, more mass market adoption. China's been able to pull that off. in large part, European companies have not been able to do that. So while, we've seen quite a bit more momentum in Europe relative to, say, the U.S., that momentum has really slowed of late, particularly as we've seen, the cost of living crisis and inflation really hitting consumers' pocketbooks. We've not seen, the growth rates that, just in the last few years were really eye-popping and getting a lot of people excited about, this transition being doable.
Our thanks to Craig Trudell, Bloomberg Global Autos Editor.
Coming up on the program, a conversation with NextEra Energy CEO John Ketchum on how the demand for power is dramatically increasing.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We begin with a look at the company NextEra Energy. Its ticker is NEE. NextEra Energy is a leading clean energy company headquartered in Juno Beach, Florida, and it provides clean, affordable, reliable electricity to approximately 5.8 million customer accounts, or more than 12 million people across Florida.
For more on how the demand for power is dramatically increasing, we were joined by NextEra Energy President and CEO John Ketchum. We began by asking him more about what his company does.
We're made up of two businesses. One, we own the nation's largest rate-regulated utility, Florida Power and Light. Mm-hmm. And two, we are the world's leader in renewables, wind, solar, battery storage, a unique combination bringing those two companies together.
But you still have nuclear and gas too, right?
We do.
For the utility side.
We do. So we cover it all. We're in every part of the energy value chain, not only renewables. We have 6 gigawatts of nuclear, and we're one of the best operators in the country on the nuclear side. And we also own gas-fired generation. 72% of our generation fleet in Florida is actually natural gas-fired. So we view ourselves really as a very credible source in being able to advise our customers on what the lowest cost option is for generation.
Owning a electric utility in Florida would seem to be a tough business with all the weather down there. What happens when these storms come through? How do you guys, you have to almost be in a constant state of emergency almost to be able to react.
We are battle tested. That's one of the great things about our company is that nothing catches us up by surprise. And it comes from a culture of continuous improvement and innovation. And we practice and we drill. And we've had, 49 hurricanes in the last 20 or 30 years. We're never caught by surprise. We're a company that is used to managing through diversity, and that's one of the strengths.
So you mentioned catch by surprise. So there was an investor presentation that you made, and where you outlined your forecast this year through 2026. Your also 2027 midpoint profit forecast. That's the one that analysts said that falls short of our estimates.
Yeah.
And I guess the question is, if data demand and data power is going to drive so much demand for your stuff, why isn't that midpoint higher?
Well, here's what we see, and we talked a lot about this at the Analyst Day. There are 3 things that I think really differentiate NextEra as part of our value story. 1, we're seeing an inflection point in power demand. 2, it's going to be met by renewables because it's low cost, fast to deploy, and it's clean. And no company's better positioned to meet it than we are. And our business model has always been what I would call a replacement cycle. We are building new renewables to replace higher cost coal plants, higher cost, less efficient gas-fired units, oil-fired units. We now have this new opportunity that's really emerged in the last 6 to 9 months, which is what I call our growth cycle opportunity. It's a new demand that has come, and it's across industries. It's not just data centers get a lot of discussion, but it's industrial electrification, reshoring to manufacturing as well. But when you think about it, we're having all these discussions with these customers now. I'll take data centers, for example. It takes 2 to 3 years to build a data center, so they won't need the power until 2027. We might sign a contract today, but the power comes in 27, which means it contributes in 28. And so what we're trying to explain to investors, look, we have a tremendous long-term growth outlook, but a lot of this growth cycle demand is really going to start materializing and producing revenues and earnings in 27, which means it really starts to contribute in 28.
As you walk through Midtown Manhattan, you probably see some empty office space here. I think they all moved down to your state. Talk to us about how that's impacted your business in terms of demand and maybe what you have to invest back into your grid.
Yeah, and that's what's great about our business, right, is the barbell approach. We've got the nation's leading rate-regulated utility in Florida and the world's leader in renewables. In Florida, we're seeing tremendous growth. Over the next 20 years, we're projecting a 44% increase in GDP. We have 1,000 people a day moving to the state of Florida. 4 of the 5 fastest growing metropolitan areas in the United States are in Florida. If Florida were a country, it would have the 14th largest economy in the world. And we're there to power all that growth. So our growth story is not only about what I just discussed about all this renewable demand that we see powering AI and industry and manufacturing across the United States, but it's also all the growth that we see right in our own backyard in Florida.
Talk to me about rates. So you're going to need to invest a lot, right? Like there's going to be an enormous investment cycle, as you mentioned, like the growth cycle for utilities, right? What is it like on the regulated side of going back to the government and saying, okay, guys, I got to invest it. You got to raise the rates.
Yeah, and so what we do is we have done a terrific job of taking cost out of our business. So when you look at what we've been able to do over the last 20 years, our O&M on a dollar per megawatt hour basis is 70% lower than the national average. That's $3 billion we put in our customer's pocketbook every single year compared to an average utility. And we've always been able to make really smart capital investment decisions around bringing low-cost generation into the fold. And the lowest cost generation option that we have in Florida is solar and storage. So although we're investing more capital, it's actually lowering the bill because it's a lot cheaper than other generation alternatives, combined with our ability to take cost out with the way we operate.
But from your investor's perspective, is a unit of power from a renewable source, what's the profit margin on that versus maybe an existing source?
Well, when you think about renewables, I mean, renewables, have really strong returns. And they're low cost, and you talked about interest rates being one of the factors. We pass those costs through to our customers, and so the cost of wind and solar has gone up a little bit as we've seen some pressure here from the macro environment. So have cost increase for every other type of generation. Actually, gas-fired generation has really gone up in price. And so, what we have seen with gas-fired technology is a 50% increase in the last 12 months. That has not happened to renewables, making renewables even lower cost than they've ever been on a relative basis to gas turbine options.
So what I hear is that everything is just more expensive because that's the environment that we're in. But because you're able to take costs out, the rate payer may not get hit as hard. Is that a fair statement?
That's exactly right. And so what we've been able to do in Florida, our bill is 37% lower than the national average. 37%. It's because of our ability to take all those costs out of the company and also offer them low-cost renewable solutions as part of the generation mix. And when you put those two together, that's how we're able to achieve that 37% lower bill than the rest of the nation. That's a really compelling customer value proposition and investor value proposition.
Our thanks to John Ketchum, President and CEO of NextEra Energy.
Staying with energy, we have something here at Bloomberg called Bloomberg New Energy Finance. The idea behind it is to provide data on commodities, power, transport, industries, buildings, and agriculture, plus new technology.
This week, we looked at how the energy transition will drive a significant uptick in demand for metals.
Bloomberg NEF estimates $6 trillion worth of key metals will be needed between 2022 and 2050, and to reach net zero emissions by mid-century, that number leaps to $10 trillion.
For more, we were joined by Sung Choi, Bloomberg BNEF Metals and Mining Analyst. We first asked Sung to comment about the amount of metal that would be needed in the energy transition.
As we progress through the technologies where we shift from fossil fuel to clean energy, and with the innovation in technologies, especially in the transportation sector and data sector as well, and power grids, more metals will be needed. In order to get the electrons flow, you need metals. That's pretty obvious, right? Now, the particular categories of metals that are of interest lately is lithium and copper. Those two metals are very interesting at this moment.
Where do we get these metals, and is that a concern where we do get them?
Yes, that is a concern. So for me, demand is of a concern, but it isn't too much of a concern. Supply is more of the concern. The reason for that is, the reason that I say that is because many of the places that have this particular resource, such as copper and lithium, are in areas where it has very sensitive political and social landscape. And in order to get those supply out of the ground, right, miners have to navigate through those complicated situations, right? For example, just starting this year or end of last year, many people forecast that the copper will be in surplus for 2024.
Will be a surplus?
Yeah, it will be a slight surplus for 2024. That was the expectation.
Okay.
But then at the start of this year, right, in Panama, Cobre Panama was shut down for many reasons, right? As a result of that, we're experiencing this run up in copper prices, right? Because there's a dislocation between copper mine supply and the smelter capacity.
So here is where I think raises the problem, because you're looking at a structural shift among metals that are cyclical. So that's one area where we were surprised to the upside, and now we're going to see a deficit. But then I look at lithium, and we knew the EV revolution and the batteries, we were going to need lithium. So all of a sudden, the lithium guys, and a lot of them are in South America, went gangbusters. They're like, we need all this lithium. It's going to be awesome. The demand's going to be there. And then the prices crashed. And then they had to shut down some of their operations because it wasn't economic anymore. We do need the lithium,
right,
but we didn't need it that day.
Yeah.
How do we manage that?
So, with everything, timing is everything, but it's really impossible to predict any type of timing with any type of investments, right? So copper is in its moment right now. For lithium, that was 2 years ago, right? All this hype around electric vehicles, use of lithium, difficulties in getting lithium. So all the investment poured into lithium space, and as a result of that, there is an oversupply issue with lithium, right? But despite the oversupply issue, the lithium industry is at the cusp of a paradigm shift in technology innovation, right? There's this thing called direct lithium extraction technology, where you take the...
Direct lithium extraction?
Yes, direct lithium extraction technology. So there's two routes where you could extract lithium. There's mainly hard rock lithium, where you take the spodumene, you mine it out of rock, and you process it. Other process is brine. You take the brine, and you extract the lithium out of it. But
water, think water, basically.
Yes. Okay. But using evaporative method. So you're using sunlight to evaporate the water out of it and extract lithium. And that takes 2 years. Now, DLE, or direct lithium extraction process, that's gonna bring that lead time down to 2 weeks instead of 2 years.
Oh.
So main competition versus hard rock, that is, right? Now that's going to be a game changer for the industry, where it's gonna actually lower the cost curve, right? It may lower the cost curve. It's a bit too early to tell right now, but at the cusp of commercialization of this technology, it may lower the cost curve, and it may change the industry forever.
Our thanks to Sung Choi, Bloomberg NEF Metals and Mining Analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.